Hi and welcome to Swissquote's daily market talk for another episode full of twists and turns. We are Thursday, January 15th, and the headlines continue to run hot. On the geopolitical front, there is some relief after Iran reported to de-escalate tensions and the US will hold off on military intervention for now. On the trade front, the US approved Nvidia's H200 chip exports to China on Wednesday, but the company will be paying a 25% import tax when chips will pass through the US before being reshipped to China and elsewhere. And elsewhere, rising metal and electricity prices raise questions about the profitability of data centers. So we will talk about who feels the heat and how markets react in detail. But before we do, please keep in mind that opinions are my own and this is not financial advice.
This show is brought to you by Swissquote.
So US crude falls sharply this morning, nearly 3% at the time I'm talking here this morning, and after approaching the 200-day moving average yesterday, that's near $62.50 per barrel level after the latest report suggests that the killing in Iran may have stopped and the US said that it might hold off on attacking Iran for now. Silver, on the other hand, fell more than 5% as well, while the pullback in gold prices was much more moderate than that. We actually see under a 1% price pullback from an all-time high level this morning for the yellow metal. Copper futures are also down by up to 1.76% right now from an all-time high level, and even though the Iranian worries seem to be easing this morning, well, tensions remain. And even though encouraging news encouraged a pullback in prices of these metals, the commodities that saw safety inflows in the last couple of hours and days and weeks, well, the so-called debasement trade, which is caused by broader political and geopolitical implications of the White House policies, is set to continue, weakening appetite for the US dollar and eventually the US treasuries and maybe also the US stocks down the line. Look, the trade tensions have fallen to the background as the geopolitical headlines were running so hot since the start of this year, but trade negotiations between the US and partners do continue and the news are running on the background and they're not necessarily super encouraging. The Supreme Court, on the other hand, again delayed ruling on the legality of Mr. T's tariffs yesterday, and the next ruling is at least 1 week ahead of us and you're not even sure that we are going to get anything out of that. While the US, in the meantime, approved the sale of the H200 chips from Nvidia to China, but also said that they would impose 25% tariffs as part of this deal, suggesting that it is never easy to navigate through these headlines. Now, under this new order signed yesterday, the US government, as I said, would collect 25% import tax on the chips when Nvidia brings them from Taiwan's TSMC factory, actually builds them in Taiwan right now, to the US before finally shipping them back to the Chinese customers and other foreign markets. That's the cost of making business at the US right now. But more importantly, it comes as another warning that the fees and tariffs for any business out there, whether you are talking about credit card business, banks, healthcare, chip business, everything out there, the tariffs could be imposed today, pull back later, the rules of the game change all the time, and the predictability in financial or business development terms is no longer a thing when the US is involved. Is this bad news for Nvidia? Well, China doesn't have a chip as strong as Nvidia's H200 chips, and Chinese could be interested in buying these chips until their chip companies close the technology gap. But make no mistake, the US political risks are only part of the story, and there are the Chinese political risks involved, as China also said that they are actually blocking the import of H200 chips according to latest reports. For them, it's a fine line to walk, obviously, between getting the latest technology from the US and supporting the domestic chip industry to make enough progress fast enough to catch up with the Western peers. In all cases, Nvidia's CEO Jensen Huang has been very clear and he has been insisting that they actually assume that their Chinese sales will be zero in the foreseeable future, meaning that anything that comes on top of zero would be the cherry on top. And they can give themselves this luxury because demand from outside China remains strong anyway. How strong? Well, the upcoming earnings from Nvidia and other companies will tell, but the news overall does not really change Nvidia's outlook massively for investors. Down the supply chain, the Taiwanese TSMC, which builds chips that NVIDIA designs, surpassed expectations when it released its full quarter earnings today in Taiwan. The revenue there grew by more than 30%, surpassing their own forecast, and 25% growth penciled in by analysts as well. And they said that the strong AI demand will continue to drive growth in the longer run. Last, the stock price is down by more than 1% this morning after the earnings announcements, and that probably on latest tariff news from the US. The company is actually planning to open 6 fabs in the United States to manufacture these chips in the US on the US soil and avoid import tariffs. But even then, there is no guarantee whatsoever that the trade rules won't change in between. You know, it takes time to build these plans and the news change so rapidly. And even if everything goes well, it costs around $20 billion to build one chip facility, and it will be 30 to 50% higher, more expensive to run one compared to running them in Taiwan. So building these chips in the US will certainly eat into the company's profit margins and possibly into its clients' margins as well, depending on how much of these costs they could pass on. Either way, nothing that happens here or in other US sectors is what you would expect from a free capital market, and the long-term cost may be much higher than what we see today and what we would imagine for this economy. Like the US bank earnings, for example, were quite mixed, but every bank that reported earnings saw its stock price fall significantly because the 10% cap on the credit card rates was to blame, and there's nothing you can do about it. Anyway, let's stay in technology and with short-term costs. On top of the US tariffs, the global technology companies, especially the data centers, are today facing increasing prices for metals that they use to build their data centers. One of them, you guessed it, is copper, that saw its price on COMEX rose 50% last year, 90% since mid-July 2022, and 200% since 2020. The question is, what is the impact on different technology companies? For data center operators, well, rising input prices will naturally squeeze margins. But the ripple effects through the supply chain will depend on 1, how much these additional costs will impact clients, and 2, the price elasticity of the end customer. Big data center providers, for instance, including Google, Microsoft, and Amazon, will be feeling the heat as it would be costlier to build data centers and run them. If you add also the predicted rise in electricity costs to run them. And bad news is that the data center revenue is the biggest contributor to the growth. But the good news is that they represent only a part of these companies' total revenues. In the third quarter of last year, for example, Google Cloud revenues stood for only 12% of the company's total revenue. As such, the impact of higher costs on data centers, whether it's higher metal prices or electricity, could be absorbed and have a marginal impact on overall profitability of the company. And a similar reasoning could be applied to Microsoft and Amazon as well. Further down the line, for the chip designers like NVIDIA and AMD, for example, the impact will be even less than that. These companies have such a high pricing power, so little price elasticity, and so high margins. We're talking about more than a 73% gross margin for NVIDIA in its latest quarter results, that the impact would be just marginal. And the setup of high margin and small price elasticity will remain unchanged as long as AI demand for these AI chips remains this strong. Therefore, your favorite chip maker's ability to pass additional costs onto their clients should help them defend their profit margins and keep them at a safe spot despite the rising metals and electricity costs. For the rest of the economy, the rising input costs will obviously increase the cost of AI, the cost of running models, but the impact on the overall sector growth remains to be seen for now. AI does increase productivity and reduce costs, and gains in many cases will remain higher than the additional costs. And frankly, for many companies in technology and outside technology, man-made trade tensions, supply restrictions on imported metals, and tariffs do represent a higher risk than the input prices themselves, because the input prices are also influenced today highly by these geopolitical and political decisions. So the source of the problem is not the price itself, but is bigger than that. So this is all for today. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please Do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, on LinkedIn, but also on WhatsApp, Threads, Telegram, and Blue Sky for regular market updates. Subscribe to our YouTube channel for daily market comments. And please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow. And until then, good day trading.
Trading and investing carry risks, including capital loss. CFDs in digital assets are volatile and not suitable for everyone. Swissquote assumes no responsibility for accuracy or losses from its use. Products and services are offered only where legally permitted.